we've got a busy day. We've got a lot of new things. tastyfx is always working on new initiatives to bring trading to a larger audience, get them excited about trading and learning how to adopt product, how to trade product. And we're going to talk a little bit today, which is great, about correlations, which, again, if you're coming from the Tasty universe, you know about correlations, you know about the idea of diversification and non-correlated returns and building out portfolios, whether it's a traditional stock portfolio or stocks, options, futures, stocks, options, futures, and FX. And, there is no set order. Usually, the order I just went through is often a traditional order, and that's a function of you start with zero leverage and you go to things with a little bit more leverage. Now, part of the reason you did that was that leverage, which gives us capital efficiency, oftentimes comes in chunkier sizes. So, yes, I'm trading more, but and I'm using less capital to do so, but it's a bigger piece that can move more. One of the things that is great with OTCFX is SpotFX is you can take that size down a lot. So you're not compelled to trade 100 lots with an option or a larger future. Even, E-minis were built because the big S&P traded S&P was too big. E-minis now are, where are we? Yeah, they're almost a 300. We're edging in on 6,000, which will make it a $300,000 product for an E-mini. So a micro is $30,000. It's still a big slice. Here, you can tailor that slice down to, approximately $1,000 of notional. So still has leverage. There's still risk. You can lose more than you put up. But you can, one of the things I always learned when I started my life trading currencies and expanded into trading other things, the proclivity to take the sizes you're trading in something you're familiar with and the sizes you're trading with something new, it's a tough place to start because you're not comfortable around it. So scaling into size, you can always get bigger, but this is a product that lets you start small. So it's a great way to be able to do that a little bit. And when we look at today, we're midweek in a relatively quiet week. Inside day for FX yesterday. I think sterling had a 30 pip range, euro 25 pip. It wasn't particularly, you can define on how you say interesting, but there wasn't a lot going on. What we're seeing today.
If we could pull up the platform. Nice.
Thanks, guys.
Yeah, yesterday inside move, but still getting like lower and lower prices in that euro. Now, are we back above 109? No, not even. So still lows back to now early August.
Right. And now equities put in all-time highs before pulling some off the table. It's so weird. And this is why, NASDAQ had been on an absolute tear, and it was some large chip maker in Europe that had a profit warning. In the bigger scheme of stuff,
right.
Was it an excuse to take some winners off the table? Probably. Are we still at very high levels? Absolutely. But this is the back and forth. Sometimes we see the dollar be part of that component. Yesterday, not so much. But we are seeing, it's interesting because we're seeing things like euro, things like, let me get to...
Yeah, pound moving a little bit.
Pound moving a little bit today too, finally giving back a little bit of ground. It looks like we're getting awfully close to testing that inflection level. We got to 150 in yen and came off. 130, again, don't get trapped around the idea that big round numbers mean anything. They tend to be interesting inflection points sometimes, so we'll see how the market reacts to that. But we're seeing some consistent dollar strength here. And dollar strength, again, when you're trading a currency pair here, again, GBP, USD, if this market is up, it means this pound is outperforming the dollar. We're always looking at the relative value of two different instruments. So that's all it is and through the watch list here, we can have them all dollar-based. We can look at the interest of a particular currency to the dollar, or we can look at, again, something that is very heavily traded is sterling versus euro. A very different looking chart. Why? We've removed the dollar component. We're looking at two different non-dollar currency pairs against one another. Constructing this trade in the world of ETFs, with like an FXY or an FXB and something, very difficult to do, very expensive to do. To construct it in futures, same challenge. You're having to weight two different currency products, and you're having to get margined on both sides. So a little bit of a challenge. So when we look at new product ideas and new ways to trade, This is one of the great things with spot FX is we can size up trade ideas that are a little bit different. And if we go in here, we can break this down and take a look at a little bit shorter time frame here, and just roll that in. So,
Oh, wow.
so we saw a lot of movement here when back in June, when we saw the correction in sterling from 135 back down to 130. So a lot of movement there. Now we're seeing a little bit of consolidation around this level. And this is, we've talked about this before. This is kind of we've held the low, we've chopped around, but the market's going to put the longs to a test a little bit.
Right.
So will we hold these lows and see a rebound? Different set of trading opportunities than just looking at sterling yet. Some similarities to that chart, but a little bit of relationship, because we know that both euro and sterling have a positive correlation to a negative correlation to the dollar. So in other words, they both, when you trade these against the dollar, you'll get a similar move to varying degrees. If you want to look at the nuanced difference, you can look at euro USD, sterling USD, or you can look at the cross. So it's really giving you three distinct tradable opportunities, all within that euro sterling environment. So looking at the major pairs are where we get oftentimes the most clarity around whether it be a central bank data release. Now, on Thursday, I believe the ECB is meeting.
Yep.
We'll get some interest there as we move forward. But I want to jump over and take a look at something you've done. Let's just run through the commodity currencies really quickly. We'll take a look at Aussie. Aussie's still having a hard time holding in there. Kiwi, same thing. A little bit, we've looked a lot at that. So a little bit different story here. Kiwi actually, which was hit harder, is getting a little bit bigger bounce. And let's just go back to the daily so we can look at apples to apples. Kiwi still getting a little bit bounce off the lows, but relative to Aussie, hit much more dramatically. Aussie coming back to the middle of its range, while Kiwi, again, the commodity currency, sitting near the lower end of its range. And we can also look at Aussie New Zealand. So this is taking out the dollar component. We looked at Aussie US, Kiwi US, and this is looking at the relationship of those two. And we can see the outperformance. This is telling us that Aussie is outperforming relative to Kiwi. So just another pair, another way to look at tradable opportunities in different extremes. One of the interesting plays we saw yesterday, and we've seen a lot of movement in, is dollar max. And I saw a push notification go out yesterday, and Glenn is our guru of all things engagement. So he has driven a lot of really interesting, and these are easy things to sign up for. But I think we've seen, again, dollar max be a really interesting trade when we look at the movement we've had just since midsummer through that huge move of the dollar outperforming the Mexican peso here, back up to levels we haven't seen in quite a while.
Yeah, and
so
it's funny off that Trump was here, right?
Right.
Said tariffs, the most beautiful word in the dictionary, and really sent that Mexican peso down bad, and it even trickled into a euro Mexican peso. Looked at that as well.
It did.
Both near 2% moves yesterday.
So, and when you're looking at, if you're contrarian, looking at extremes, you hear 1%, 2%. Now, FX majors on average, I think over the last 20 years, move about 2.8% a year.
Right.
That's an average, not always the case. But when you hear 2% a day, the contrarian in me gets interested.
Yeah.
Do I find a trade? I don't know. But it's certainly something I look at. It would be like, gold's up 2%. Crude's down 3%. Those are interesting moves.
Right.
Because at that point, somebody's getting challenged. Either the longs or the shorts are getting challenged usually. And that creates interesting inflection points. Same things here. So, one of the takeaways of us discussing this and talking about FX is to get that product adoption piece easy and off the table. We want to understand construction. We want to understand it's got leverage. It's important to understand that so you understand what you're risking and what you're trading. Scaling the leverage down by sizing's important benefit that we have. But you want to be able to take that, what interests you in crude, or Apple for that matter,
right,
or NVIDIA or gold. If that kind of price action is interesting to you, there's an opportunity to find it in this world too. And that product adoption part of our goal at tastyfx is to make you feel as comfortable in these products as you would any other. So as you go and look for that second level diversification, and you're the guy looking for extremes, either it's a momentum ground, like, okay, we're in new ground. It's so funny. I talked to an old buddy of mine yesterday, and he's like, yeah, these tech stuff, it's going to explode to the upside. And all I'm thinking is it's so overdone. And that's the contrarian me who's always looking to fade a move. And that's the momentum in him that, again, he's been very successful writing some of these things far past areas I would think are reasonable. But markets tend to overprice to a point. So finding that opportunity here is the same thing. But one of the things we want to talk about, let's jump over to the slides if we can, is let's talk about commodity correlations. And Glen's done some great work walking us through this. So talk a little bit about what's here, because this is great content.
I mean, just a high-level overview. First, covering why commodities would affect currencies. I'm sure you know a lot more about this than I do, but when we're talking about currencies and the strength of currencies, it's going to be a really complex story. So many factors that go into it, so much that could possibly move it, expectations in the near term, long term. But a lot has to do with a country's economic performance, their GDP, and commodities in certain countries can have an outsized effect on that GDP, whether it be from a resource-driven economy like Canada historically, or Australia with a lot of minerals, or importing commodities that may be impacted by rising prices. Japan imports a lot of oil.
Right.
If those prices sky high, then maybe that impacts their economy's bottom line. And then also, the play we see across asset classes having to do with risk sentiment, risk off moves. Gold is can get a lot of bids there, but riskier commodities, maybe not, and safe haven currencies, traditionally, the dollar, the yen, the Swiss franc.
Right.
So a lot of these move in tandem. There's usually a third variable, but you
So
can,
glad you said that.
You can tend to see a lot of these swings in both assets. So did I miss anything there?
No, I think you summed it up in something that would have taken me 4 slides to write. So I love I think these are 3 drivers that can impact markets at certain times. Is it always if crude's up, Canada is higher? No. If crude's up, is yen lower against pairs? Not necessarily. But a contributing factor, if crude moves from 60 to 80, chances are you're going to see the yen underperform other currencies.
Right.
To what degree? That's deterrent. So what this does is it gives me some causality. It doesn't give me a Bible of certainty. And we're going to talk to the certainty by the greatest, to judge the degree of certainty, the best way to look at it is, what are the correlations?
Yep.
And that's where we're going to go less. So no, I think these are 3 buckets of, okay, what creates a tradable opportunity? What is changing in the world again, we're not necessarily trading on news. What we are is putting context around our trade ideas and taking, if there is an interesting correlation, wrapping that in to, you've got the opportunity to trade 80 different X pairs at tastyfx. There is, again, there's more than enough opportunity in 10 or 12 of them that you are going to find interesting. Your first foray shouldn't be into the Turkish lira or the Israeli shekel. Now, we've got customers that love that because there's a certain quality to it around carry and stuff like that they like. And that's great for them. They're advanced traders. They understand the risks that come with that. But this kind of context gives you great sense. So walk us through what you found when we look at these commodities and where the correlations lie.
Exactly, and you nailed it. We'll cook through these because you'll see very quickly that a lot of these commodity-based currencies show up time and time again, but there are some nuances, conclusions we can draw from them. And so here, first looking at gold, we have the 3-month correlations and then the 3-year correlations.
Good.
To kind of, these economic environments are ever-changing. 3 months, kind of a small snippet of the year so far, and then 3 years trying to get more of those historical correlations. So over the past 3 months, we're seeing the New Zealand dollar and the Australian dollar highly correlated to gold. But interesting to me is on the 3-year horizon, we do see those safe haven currencies pop up in the Japanese yen and the Swiss franc.
Right. So very, very interesting here. I think what's interesting too is that you look at Aussie, the 3-month, 3-year correlation, almost the same thing.
Right.
New Zealand, US, 5 points, kind of a rounding error, same thing. You don't get the opportunity to have something diverge greatly and then still have a really high correlation.
Right.
Correlations you accept the fact that the divergence is causing the correlation to break down. So looking at long-term versus short-term correlations is interesting. So the fact that in this case, if the New Zealand U.S. market had moved dramatically and the correlation had broken down against gold, it doesn't mean it's not an interesting trade, but the correlation is not always going to be consistent when you get a divergence.
Exactly.
So looking at these two time frames, this shows there is a consistency to this. So it becomes not an everyday, can't count on it apples to apples, but there is a positive drift to it.
Yep.
That's important to say. And as you said, intuitively what we thought about on the macro level plays through in the correlations. Dollar yen, dollar Swiss, both safe havens reacting negatively to gold, where the commodity currencies having a little bit stronger correlation.
And that's where it gets interesting when you look at silver, because we're seeing higher correlations as of late, similar pairs, but in the past 3 months, that Australian dollar US dollar correlation popping above 0.5, which if the bounds are from -1 to 1,
right.
Now we're getting into a little stronger territory. But yeah, very similar to gold. But I did think it was interesting that maybe you think this correlation right now is a little bit juiced, and you look at the historical 3-year correlations; those come down,
right.
Or you think maybe that you could ride this trend, and these will stay highly correlated. So very
right.
similar to gold, but yeah, I thought that was
absolutely. And silver again, it straddles that precious base metals. There's both industrial uses and store value uses to it. So it kind of wears the skin of both an industrial metal and a precious metal.
Right.
So, but an interesting little breakdown there. Copper, the base metal story, the China story, everything. So there you're seeing your strongest correlations.
Yeah, and this is interesting because when we're looking under the context of gold and silver, this looks very similar, but you can't forget that China piece of
right.
the copper story that makes that Australian dollar so pronounced. And this is the highest correlation we'll see across the board here, is that 0.54 in the past 3 months.
Okay, and we're seeing absolutely no positive correlation to Canada. This is strictly leading into those Asian, there's Euro-Pacific, those Pacific currencies, Aussie, Kiwi,
Crude.
oil. Let's take a look at that.
Not a lot going on right now, moving very independently.
Yeah.
Who knows where that's going? But over the 3-year horizon, we do see that correlation to Canadian dollar pick up.
Right, but and I think we've seen this break down a little bit. Mm-hmm. And, I think at this point you have to accept the fact that, okay, is it diverging? Yes. Is it as useful a tool? No. So I'm not going to hang my hat
right.
on crude moves driving my Canadian dollar trading. But you know what? Let's hold off here. We'll save the balance of the slides and run through this. But this is a great exercise to lay the proffer of what do I start to build my radar around some of these commodity currencies, some of these safe haven currencies, and what are the correlations? And that creates context around why markets are moving. Not a guarantee,
right.
but context. We never get guarantees in trading. If we did, you and I would be...
You would tell me, right?
I would tell you the secret formula. Right. Yes, I would share that. But guys, thanks for tuning in.